Hello, everybody. I'm here today with Alexander Luycx, who's a managing director in the technology and software team at DC Advisory in the UK. He has over 15 years investment banking experience with particular emphasis on software, hosting, co-location, IT services, and networks. Now, I'm sure many of you know DC Advisory is an international investment bank committed to making a difference. It has 11 industry-focused teams that offer tailored independent advice on M&A, debt raising, restructuring, private capital, and access to an unrivaled Asian investment knowledge.
That's a very nice intro, Ruby, and nice to meet you.
Nice to meet you too. So we're here to have a chat, a couple of quick questions.
Sure.
And I think my very first one that I'd like to start off with is, what do you think the outlook is for the tech market, and what impact do you think the last 12 months have had?
So software and tech is perhaps one of the only sectors that have proven to be not only resilient, but very, very well performing. So when we look at last year, obviously similar to all other sectors, there was a temporary fallback in activity, but it quickly picked up again. And so we are very bullish about the overall M&A activity in software and tech for 2021.
Fantastic. Have recent economic pressures had an impact in your view on tech valuations?
That's a very good question. What we saw last year was towards the end of March when COVID really hit. Obviously, all stock markets were impacted, share prices came down quite substantially. But then we saw, particularly in software and tech, a quick rebound, particularly around SaaS businesses. They were trading above their prices pre-COVID happening. So we've seen actually valuations in stock markets being very, very high, to the effect that almost some people are wondering whether or not there's a slight disconnect between the valuations of businesses in the public market and then what is being fetched privately.
Okay. And leading on from that, what effect do you believe Brexit or other domestic factors such as CGT will have on deal flow activity in 2021? And sorry, I was going to say, do you see any other microclimates on the horizon, such as CGT or Brexit?
So Brexit was much more an uncertainty going into 2020 than it obviously is going into 2021, because we did achieve an agreement between the UK and the European Union just before Christmas. So as of 2021, we don't really see that impact. Last year, there was a lot of uncertainty, so it did impact a little bit the number of assets coming to the market in the first half of the year. But then we clearly saw towards the second half of the year a very strong and active deal flow, particularly in Q4. Most funds, most banks were very, very busy. So in summary, we don't see that repeating itself in 2021. On the CGT side, we do see very clearly that a number of situations are being driven by the perceived change in tax regulation coming. So yes, we are currently working on a number of transactions of which a timetable has been brought forward to kind of make sure the deal completes by the end of March. Now, in terms of your question, is there anything else that would have an impact on deal flow? The short answer is there's probably some assets that were earmarked to come to the market last year who are not the top quartile assets, and they will come the moment the overall situation, particularly post-COVID, has improved.
Thank you. When we look at the market, we see the changes that have occurred. One of the key questions that a lot of people ask me is, how supportive are the debt and public equity markets of M&A activity in this climate?
Yeah, so that's a good question, and we should look at both the equity and the debt market. So what you saw last year is obviously when COVID hit in March, April, that saw an impact on the equity markets, but they recovered very quickly, right? We saw, for example, the IPO of Palantir, and then we saw, the biggest software IPO ever, which was Snowflake, which was a huge success. Yes, the share price has come down since, but these were priced, last year. It was a very, very good success, right, for all the investors. So we continue to see appetite in public markets. Now, on the debt side, we observe and we see that debt markets are open, but it is obviously becoming a bit more challenging to get actual debt financing raised in terms of lenders asking more questions, taking longer to approve. They do, but it all takes a bit longer. Now, there's a subtle but clear difference in the appetite by commercial banks and credit funds. Particularly the credit funds are very active. Banks are a bit more hesitant in providing lending.
Do you think that'll change?
It will, but we have to first come out of the entire COVID situation, get to a new norm, go through some of a delayed wave of impacts that undoubtedly and unfortunately will come. And once we're through that, then likely we'll get to a new norm with the banks.
Thank you. What do you think are the key objectives of corporate buyers and private equity for making acquisitions?
Yeah, so on the corporate buyer side, look last year, right? You had Salesforce acquiring Slack, you had SAP acquiring Emarsys, you had all of the larger software businesses making very specific acquisitions around capabilities, very often around project management, communication, technology that helps people being smarter working from home, which obviously is a trend here to stay. So that is something that we have seen, we'll continue to see. The second noticeable trend that one sees is that, look, not all businesses have been performing as strongly as others in this COVID climate. And so it does provide an opportunity for larger, well-capitalized businesses to acquire subscale or slightly struggling businesses and hence strengthen their positioning and reap the benefits of synergies. On the private equity side, and that is a theme that we have seen, that we continue to see, is obviously there is a gigantic amount of capital that is seeking returns. And software and tech is one of those sectors which understandably are generating the best returns. And that's why private equity continues to be very, very interested in deploying capital in that space. And coming back to one of your questions earlier on, when you asked about what's happening towards valuation and prices, what we do observe based on transactions we've advised on over the last few months, and also situations where we're working on the buy side, top quartile assets are going for very high prices, perhaps even higher than pre-COVID, because there's a scarcity premium being paid to those assets. However, assets which are positioned as top quartile, but in fact are not, they will struggle. And so that tells you that, with a rising tide, all the boats are lifted. It was very easy for any advisor to sell a business pre-COVID. But with COVID, notwithstanding that software and tech is very resilient, you have to be really focused on how you position your business, that you do it in the right way to attract the right type of buyers.
That's a great answer, because it kind of brings me on to my next question, which was going to be, if you could talk freely and off the record to a business owner, what advice would you give them about getting the most out of any M&A activity they enter into?
So the number one thing that comes to mind is timing. Why do I say that? Getting the timing right of a transaction often makes a difference between able to do a deal or not. And what we find is that we as an advisor can be most effective at the most value when we have an interaction and get involved early on, way in advance of a founder entrepreneur thinking about a transaction. Because it does allow us to get to know the business very well and understand the trajectory of the revenue and the other financials. And on that basis, we can have a much more informed advice on when to go to market. And we've seen that consistently, is that founder entrepreneurs not always get the timing right. They build a great business, but they need to engage with an advisor earlier, because that's when we can be most effective.
When did they want to sell the business? When it's good for them, I take it, as opposed to when the market's ready for them?
It's less to do with the markets. Of course, the general market conditions need to be right, but you have to look at what is the momentum of the business, right? If you want to do a deal with private equity, like anyone else, wants to see momentum and metrics which go up. So if you've been growing very strongly, but you're starting to plateau, that's not the right time to try to do a deal with PE. You have to do it sooner. On the corporate side, very often it goes back to one-on-one sell-side banking, which is you want to make sure that your most logical trade acquirers know the business and have heard about it. And you rarely get into a situation where you can just pick up the phone and introduce a business and a strategic is going to be interested. And so you need to take the time to do that pre-marketing to make sure that your business is on the radar of trade. Now, most of the times it should be, because if you are perceived as a competitor in the space with a strong proposition and you're competing against trade, then they should know about you.
Thank you.
Pleasure.
Another question I'd like to ask, which was prompted by an earlier answer of yours, is if tech is a strategic enabler in value creation, and it's perceived by many companies as that, then one of the things that I've always wondered is, why don't we see more tech businesses acquire larger non-tech businesses and drive this impact?
So I actually believe it's the other way around. You see non-tech businesses acquiring technology. Now, why is that? Is that in many traditional industries, there is a trend to move towards industrial tech, to take the benefits of IoT into account. Many business processes are moving digital into the cloud. So what we see across a number of sectors, technology becoming more and more of an enabler. So if we look within our own firm, we work closely with business services or industrials, two sectors where you see technology increasingly coming into the equation. Now, good examples are businesses like Honeywell, General Electric, Siemens. These are all large conglomerates where in the traditional parts of their business, tech is playing an increasingly important role. And that won't stop. That will only increase because of 5G, because of IoT, because of augmented reality.
Thank you. Last question. If you're looking at the market, just looking forward into 2022 and 2023, what do you see as being the big trends?
Yeah. So on the software side, it's around AI. Now, AI is a topic that is sometimes controversial. AI is not about replacing existing jobs. AI is about making people much more effective and efficient in what they do. And that is really the power of AI. And when 5 years ago, you had this concept, or even 10 years ago, about cloud is omnipresent. We don't think anymore that an application is run in the cloud. Well, the same applies to AI. AI will be the motor of any software application, but really leveraging that capability of AI, we've only scratched the surface of it. The second trend is something I referred to a bit earlier, is around virtual and augmented reality. That is particularly towards the consumer side, but not just the consumer side. We see that continue to be a trend, and in many consumer applications, but also industrial processes, it will increasingly become a way of interacting or performing with a product, interacting with an application. Lastly, it's the omnipresence of the mobile internet, which is that the number of devices, mobile devices, will only continue to grow exponentially. And that will open up an ever number of new applications and functionality to people connecting devices, connecting workflows, connecting processes. And that is a trend that has started, but will continue to happen in the future.
Thank you very much. Alexander, thank you very much for your time today.
A pleasure.
It's been a great discussion. Really appreciated your thoughts and insights. And until next time, thank you.
Likewise. Thank you, Ruby.